Welcome, everyone. You've probably heard the old saying, when America sneezes, the world catches a cold. But for a hyper-connected, trade-reliant country like Singapore, a U.S. slowdown can feel more like a full-blown flu. Today, we're diving deep into what a cooling U.S. economy in 2025 really means for Singapore. We'll cut through the jargon to see which parts of the economy might struggle, where the surprising bright spots are, and what it all means for you. Disclaimer: this video is for educational purposes only. It is not financial advice, and it should not be taken as a recommendation to buy or sell any security. Please conduct your own research or consult with a licensed financial advisor before making investment decisions. Let's get into it. First, why the long face in the U.S.? After a strong 2024, the American economy is projected to slow down significantly in 2025. Think of it like a sprinter finishing a race and needing to catch their breath. The key reasons? Lingering effects of past interest rate hikes, less government spending, and weaker consumer confidence. Now, why does this matter so much to Singapore, thousands of miles away? Two big reasons: trade and investment. 1. Trade. The U.S. is a massive customer for Singaporean goods. We're talking electronics, machinery, and pharmaceuticals. When American consumers and businesses tighten their belts, they simply buy less stuff. 2. Investment. The U.S. is the #1 foreign investor in Singapore. American companies have poured hundreds of billions of dollars into the city-state, creating jobs and driving growth. A slowdown can put those expansion plans on pause. Singapore's economy is built on global trade. In fact, its trade volume is over 3 times the size of its entire GDP. It's like a small boat that's incredibly fast and agile, but also very sensitive to the waves of the global ocean. And right now, the biggest waves come from America. But this isn't just a simple slowdown story. There's a plot twist. In 2025, the U.S. has a new baseline tariff on many imported goods, including those from Singapore. Now, you might look at the export numbers from the first half of the year and think, hey, things look great. But that's a mirage. What really happened was a phenomenon called front-loading. Singaporean companies saw the tariffs coming and rushed to ship as much as they could before the deadline. They crammed 6 months of exports into 3. The result? Warehouses across the U.S. are now stuffed to the ceiling with Singaporean products. This creates a demand cliff. U.S. importers don't need to place new orders because they're sitting on a mountain of inventory. So just as real demand from the slowing U.S. economy starts to fade, the artificial demand from front-loading also disappears. It's a double whammy that could hit Singapore's exporters hard in the second half of 2025. Okay, let's talk about money flows. When the global economy gets shaky, investors get scared. They pull their money out of riskier places and park it somewhere safe. This is called a flight to safety. Now, here's where it gets tricky for Singapore. Because of its political stability and strong laws, Singapore is seen as a safe haven in Asia. So when there's trouble in the region, money flows into Singapore. This pushes up the value of the Singapore dollar. But when there's a global scare, like a potential U.S. recession, the ultimate safe haven is the U.S. dollar itself. Money could then flow out of Singapore. This creates a real headache for Singapore Central Bank, the MAS. They'd normally want to let the Singapore dollar weaken a bit during a slowdown to help exporters. A weaker dollar makes your goods cheaper for others to buy. But if international investors keep piling money into Singapore seeking safety, it props the dollar up. This limits the MAS's ability to use its main tool to soften the economic blow. It's like trying to paddle downstream while the wind is blowing you upstream. So how will this slowdown ripple across different parts of Singapore's economy? It's a mixed bag. First, the pain points. The most exposed sector, manufacturing, especially electronics. That new phone or laptop you're eyeing, many of its components come from or through Singapore. With lower U.S. demand, this sector, which was a star performer, is facing a major slowdown. Next, traditional banking. When the U.S. Fed cuts interest rates to boost its economy, Singapore's rates follow. This is bad news for banks' profits. The gap between what they earn on loans and what they pay on deposits gets squeezed. The big local banks are already warning about this. But it's not all doom and gloom. Now for the bright spots. First up, wealth management. While traditional banking suffers, Singapore's status as a safe, stable hub for the world's wealthy is a huge advantage. As global markets get volatile, more high net worth individuals park their cash here. This generates fees for banks like DBS, creating a neat internal hedge. The clearest potential winner is real estate and REITs. Lower interest rates are like a magic pill for the property market. Borrowing becomes cheaper for home buyers, and for real estate investment trusts, their high dividend yields suddenly look much more attractive compared to falling bond yields. Look out for REITs focused on essential services like logistics and suburban retail. Finally, a powerful buffer: tourism. Visitor numbers are set to roar back past pre-pandemic levels, thanks in large part to a new visa-free arrangement with China. This flood of tourists spending money on hotels, food, and shopping provides a much-needed cushion for the domestic economy. So how could this all play out? Let's imagine 3 possible scenarios for late 2025 and beyond. First, the downside case: U.S. recession. America's slowdown turns into a mild recession. U.S. tariffs are expanded. In this world, Singapore's growth grinds to a halt and markets see a sharp correction. Second, the base case: a bumpy landing. This is the most likely path. The U.S. slows down as expected but avoids a recession. Singapore's growth cools to about 1.7%. The market trades sideways with defensive sectors outperforming. And finally, the upside case: a soft landing. The U.S. economy proves more resilient, tariffs are negotiated down, and a strong recovery in China provides an extra boost. Here, Singapore's growth could rebound closer to 3%, and we could see a broad market rally. So, what's the takeaway for investors? The name of the game is defense. The smart money is shifting away from high-risk growth assets and towards quality. Think companies with stable cash flows, low debt, and a solid history of paying dividends. The Singaporean economy is at a crossroads. The artificial boost from early 2025 is fading, revealing a more challenging road ahead. But with strong fundamentals and several bright spots, Singapore is well equipped to navigate the turbulence. We'll be watching the key data points, like exports and policy statements. If you found this breakdown helpful, do us a huge favor and hit that like button, share this video, and subscribe for more deep dives into the forces shaping our financial world. Thanks for watching, and stay sharp.